It's my pleasure to host a panel on housing policy and current state of affairs here in the Beltway. To join us, I'd like to introduce Isaac Boltanski, the Director of Policy Research for Compass Point Research and Trading, Bob Broekschmidt, CEO of the Mortgage Bankers Association, Ed DeMarco, President of the Housing Policy Council, and Lori Goodman, Vice President at the Urban Institute and Co-Director of the Housing Finance Policy Center. We will get started now. Thanks, guys. Go ahead. Well, thank you all for being here today. I think to get started, I would like to ask each of you what it is that you are all most focused on in the housing policy space. And if you could, talk about that, but then also add what you think is being maybe misunderstood or overlooked in the conversation that we're all having today.
Sure, I'll start. My name is Isaac Boltanski. I work at Compass Point. We're a small investment bank, and my clients are hedge funds and mutual funds. And generally, hedge funds tend to have attention spans of gnats with ADD. So it's great to be with folks who have a much longer view on the world and talk about longer-term policies. The thing in that vein, the thing that I'm focused on most at this moment is the forthcoming White House plan on mortgage finance reform. This stemmed from a memo that the president signed a few weeks ago. We expect it in the next few weeks. We don't know when exactly, but hopefully by the end of July. And this memo is going to focus on 17 different objectives that were outlined by the original release. And this is incredibly important because we are at an interesting phase right now where we have both people and process aligned in Washington to actually advance some degree of change in the mortgage finance ecosystem. And in particular, I think that we're going to be focused on 11 of those 17 objectives that have to do with the GSEs. And we'll hear later today, luckily, from FHFA Director Calabria. And I think that what I'm looking for in that is what can be done administratively versus what can be done and would have to be done through Congress. And just to answer the last part, your second question there, I think that divide is what's most misunderstood, at least in my part of the world, the investor community. There are a panoply of things that can be done administratively. A curtailment of the GSE footprint, a reduction of GSE privilege, all of those things can be done administratively. But there's some big ticket items that need Congress, things like the explicit guarantee and so on. So that's what I'm focused on, and that's the biggest item that I think is misconstrued.
Thank you. Bob?
Thank you, Maren. Thanks for having me here. And I will, not surprisingly, echo Isaac and say that GSE reform, as our chair at the Mortgage Bankers Association, Chris George, likes to say, has been our top priority since the late 1800s. And while that's not literally true, sometimes it seems that way as we're in the 11th year of the conservatorship. But looking at what's going on, and in fact, I've been in this business 34 years. I toiled in obscurity for the first 20 or so, and nobody knew or cared about mortgages until the Great Recession. And now I start to wish it were like it used to be and we could toil in obscurity. But on the way here today, I pick up the Wall Street Journal and there are 3 articles on mortgages. There's the front page article about how refinances are spiking because of the rates dropping. There was an article about Director Calabria asking Congress for authority to charter new entrants. And then there was a herd on the street thing saying, here's what they're saying about GSE reform and here's how difficult it will really be to do it. So it is a very topical issue, and as Isaac pointed out, the what can be done administratively, which Director Calabria has certainly signaled he will do as quickly as he can, and then the real dance that we watch in Washington is how the executive branch and the legislative branch interact on this, because as Isaac said, Congress must act in order for there to be an explicit guarantee on the mortgage-backed securities issued by Fannie and Freddie and any other entrant that there might be. And Congress must act to give Director Calabria the authority to charter new entrants and to provide competition, both of which we at the MBA favor. Director Calabria also cannot act so precipitously that the only way Congress acts is to stymie him. And in the last Congress, that is a bill that they passed inexplicably called the Jumpstart Act, which actually prevented the government from selling any of its shares of Fannie or Freddie without congressional approval. So that's the dance we're seeing between the executive and the legislative branch, and it's fascinating. And of course, at the Mortgage Bankers Association, it's also our top priority. I want to mention one thing, Maren, to your question about what's maybe a little less understood. At the Mortgage Bankers Association, our membership includes the biggest banks in the country down to the smallest community banks. It includes credit unions, and it includes real estate investment trusts, but it includes a whole swath of independent mortgage bankers, which are non-depository institutions, which make up a majority of Ginnie Mae issuers at this point. And something that hasn't been well understood is the difference between independent mortgage banks and depositories, how they are regulated. There's been what I believe is a false narrative that independent mortgage banks aren't regulated. Talk to any independent mortgage banker in the room here, and they'll tell you they are vigorously regulated on all sorts of levels. And we welcome Ginnie Mae's efforts to balance your very appropriate need to ensure the taxpayers are protected and that you're dealing with sound counterparties, with the need to be transparent with our members as they go through these analyses of their liquidity and their capital needs. So we appreciate working together with you jointly on that, dispelling myths while also ensuring that the taxpayers are protected.
And I think you bring up a good point, is that there's an opportunity for us all to collaborate on this. So where there is regulation today, let's make sure we're informed about what that is. How do our policies then potentially interact with that? So I think that's exactly right, is threading that needle. It's going to be hard, but I think it's going to be very important. So thanks for bringing that up. Ed?
Yeah, thanks, Maren. Thanks for having us, and good morning, everybody. Let me just, rather than repeat, let me add a couple more things. I think in terms of what's going on in Washington policy and what we're focused on at the Housing Policy Council, to prepare for housing finance reform, we also need to think about where the private market is and what's needed for the private market to actually play a greater role. And I think that there's several administrative steps that can be taken that would really help prepare for that and help enable a return of that private sector thing. So focusing on leveling the playing field, I think a few things to call out. One is the ability to repay qualified mortgage rule of the CFPB. This rule today has a clear and substantial slant into Fannie Mae and Freddie Mac, and it also makes it more challenging than it should be for the private sector, for the private securitization market to be able to return. So the first thing I'd say is that the QM rule needs to be addressed by CFPB. Second, private securitization itself is a bit stymied by an important but overwrought rule from the Securities and Exchange Commission, and that's Reg AB2, which governs the disclosures around securitization. And I think if we want to expect and want to see an expansion of private securitization, so not Ginnie, not Fannie, Freddie, we've got to address this rule, which is making it very difficult to actually do registered deals. And third thing I'd say is that if you want to bring private capital back into the mortgage space, to shift this risk from taxpayers to more into private capital, one of the things those investors in mortgage credit risk are going to need is better data. And there's an awful lot of mortgage data that's bottled up inside of Fannie Mae and Freddie Mac in terms of historical loan level performance data, collateral data, and I think the more we can get that into the marketplace so that a much broader pool of capital participants can evaluate data and make better informed judgments about risk, that will certainly encourage their re-entry into this space and will also reduce uncertainty. Final thing in terms of leveling the playing field, To Bob's point about, there's banks, non-banks, and so forth, this mortgage ecosystem, a $10 trillion single-family mortgage market, has so many different regulated participants, but one of the key areas of regulation where there's still an awful lot of inconsistency has to do with capital regulation. You take the same mortgage and however this thing is being financed, end up with substantially different capital needing to be held. And I think collectively our federal financial regulators really need to take a much harder look at how they think about capital requirements in the mortgage space and the different ways in which it can be financed. We ought to be encouraging the laying off of risk. We ought to be encouraging this broad participation. But right now, these differential capital requiremements, again, tilt the playing field. So I think leveling the playing field in these different ways is really important to the future of our mortgage system. I want to also touch on technology. I mean, I think sort of continued technological innovation in this space is really important, and it is coming, but some of these regulatory changes help. And Maren, you also asked sort of, things that are misunderstood or maybe being overlooked. Especially given this audience, I'd like to take a minute and talk about FHA. The FHA program is the government's flagship program for supporting affordable housing opportunities in this country, and yet the FHA program is in need of such substantial modernization. And I'm not talking just about technology, although goodness knows technology modernization is so essential for FHA, but just how FHA operates as a mortgage insurance company, how it deals with its customers. Its customers are the member institutions that Bob and I represent, and being able to work with the industry in a way that's consistent with how the industry itself works, how it works with Fannie and Freddie, is a really important thing that needs to get addressed. So we're really interested in the modernization of FHA just as a government corporation being able to do its mission. So Bob and Isaac talked about the Treasury report that's forthcoming. There's also a HUD report forthcoming, and I really hope that HUD report takes a time to talk about how to make FHA be able to work more effectively, have greater control over its resources, so it can be a better partner to everybody in this room, and also be able to better serve its mission. My final thing on what's being overlooked is this is really hard to do in government policy, but we really do need lawmakers not just to think about ending the conservatorships. We need to think about what federal housing policy in the 21st century looks like. What's the role of the government? Where does it fit in? And how does it think about these different things it's sponsoring or encouraging? How are they expected to work together? I mean, not the least of which is how does FHA, in its segment of the market, supposed to relate to and align with what's going on in what is either the Fannie Freddie sector or what replaces what we've known as the Fannie Freddie sector. So that's plenty to chew on. But
absolutely, and I think you're right, because I think, and that's why the presidential memo that we put out has both a directive for Treasury and for HUD. I think we have worked very hard to understand the entire ecosystem, knowing that when we make changes on one side, they could have a ripple effect throughout the entire system. So we are focused on that. And the technology directive is explicitly called out in the PM. So I know the FHA team is here tomorrow with Brian speaking, as well as other senior leadership from FHA, and they will talk about the technology plan that's underway. They do have a down payment from Congress, but we do need to work with Congress to continue that funding to improve FHA's technology. So I think you hit on the exact right point. Lori, what about your thoughts?
Yeah, so the Housing Finance Policy Center at the Urban Institute was established about 5.5 years ago to provide data-driven analysis of housing finance policy issues. We provide data and analysis on a wide range of issues, and we believe that everyone is entitled to their own opinion, but everyone is not entitled to their own facts. So we work with State Street and Ginnie Mae on the Global Markets Analysis Report, which is a monthly chart book which is available on the Ginnie Mae website.
I highly encourage everyone to look at it. It has phenomenal data every month.
And we didn't have that scripted.
No, not at all.
And we also do a monthly chart book, Housing Finance at a Glance, which is available on our website. There are two issues we're particularly focused on: housing supply and access to credit. While it's a bit of an oversimplification, supply and demand, that is, net new supply of housing versus net new household formation, determines prices, and access to credit governs the tenure decision, that is, whether you're an owner or a renter. Right now, as Sam pointed out, we have an acute supply-demand imbalance. We're sort of about 350,000 units short of the rate of net household formation. And there's no easy solution. We've done some work on manufactured housing, as we believe that's part of the solution. Changes to zoning are critical. Land costs have gone up far more than the cost of the structure. But even so, building codes need to be re-examined, and there's room for expansion in manufactured and panelized units. We're also very focused on access to credit. We firmly believe that homeownership is the best way to build wealth, and that's particularly true in minority communities, and we're continuing to do work on steps to open the credit box. We put out a blog earlier this week on FHA's well-intended fix to get better capitalized firms back into the market by fixing the certification and the taxonomy, which I know is an issue that the MBA is also focused on. However, it's a very well-intentioned effort, but it doesn't address the real issue, which is the False Claims Act, in which lenders are subject to triple damages for false statements on mortgage loan applications, even if small, inadvertent, and inconsequential. So that basically our recommendation is this is best be done by the FHA working with the Department of Justice to make clear exactly what errors are subject to the False Claims Act. We also have a quarterly housing finance credit availability index. It shows that we're taking less than half the credit risk we were taking in 2001 to 2003, a period of reasonable credit standards. We, along with Ed DeMarco's group, have also done a significant work on the GSE patch and on the qualified mortgage rule. The patch expires on January 10th, 2021. I think both us and the Housing Policy Center are advocating that if the loan is less than X basis points over the benchmark mortgage rate, it should be QM eligible, whether it's a GSE loan, a portfolio loan, a PLS loan. Let's put everyone on equal footing. And then we've also done a lot of work on mortgage servicing. In particular, delinquent servicing is quite expensive and generally results in higher rates for borrowers who have lower credit, even when FHA or VA doesn't charge more. We've made suggestions on how to improve the FHA foreclosure process and how to improve government loan modifications. And I'm not going to repeat Ed's plea for better data. That was going to be a part of this as well. In terms of what's been misconstrued in Washington, I think there are three things. First, I think people look at rising housing prices and they're like, oh, the housing market is great. I think they're not. I think people are putting their head in the sand on how acute the supply shortage is, and I think as a result there have been very few federal actions to address the issue. And and while it's primarily a state and local issue, there are things federal policymakers could do. For example, tying transit funds and other state funding to higher density and other requirements. I think that needs to be looked at. And I also think policymakers have really misconstrued the lessons from the Great Recession. Somehow the talk is always, well, we only want to make sustainable mortgages. Well, everyone wants to make sustainable mortgages, but it's not clear exactly what that means. There are very few borrowers that have the ability to make their mortgage payments under all circumstances, and there are very few borrowers who will have 100% probability of default. What you really want to do is you want to sort of limit the probability of default, and I think what we've done is we've put too low a threshold on that number. Bearing in mind how valuable homeownership is to build wealth, I think today's cutoffs eliminate too many creditworthy borrowers. What we want is balance, a reasonable amount of risk alongside reasonable access to credit. That is, we think sort of what was tolerated in the 2001 to 2003 period is more appropriate than what's being tolerated now. And then finally, I think there's too much of an emphasis in DTI in both the QM rules and some of the rhetoric and underwriting. In fact, DTI, debt-to-income ratios, are by far the poorest predictor of defaults. FICO and LTV are much stronger predictors of defaults, and huge swings in debt to income make only a modest difference in the probability of default. And I think people need to think about sort of the role of, kind of the overemphasis given to DTI.
Well, I appreciate all of those thoughts. One area where I can touch on, and I know Brian, who will be here tomorrow, will do more, our FHA commissioner, is the False Claims Act and the ability to provide clarity to lenders who is going to take action where and who's responsible for enforcing. I think at the end of the day, it's very clear we have no tolerance for bad actors, but how we treat various cases, I think needs to be clarified. So we are still committed to that, and I know Brian Montgomery will touch on that more tomorrow. I think each of you, to some degree, touched on this, but I do think we should all talk about affordability. It is something that is present in almost every conversation we have, and we talk a lot about what's driving affordability and the affordability crisis, but it's hard to talk about solutions, and I think maybe we can start to explore some of that. Bob, I would ask you, what is important to your members when it comes to housing affordability, and where do you start to address the issue? How do you balance this with the risk factors that tend to then increase as affordability becomes more constrained?
I think this is the central issue for our industry, and at MBA we're announcing today that we are naming Steve O'Connor, who's been a 23-year member of our team, as Senior Vice President, and making him Senior Vice President for Affordable Housing Initiatives, where they're going to backfill so that he really can do this full-time and not be expected to do all of the other things that he does. And he's going to lead this initiative for us, and we're going to work closely with our members who are very enthusiastic about it. And exactly what form it will take, we won't know until we get into it, but we think that there are lots of really creative, effective things being done by our members on smaller scales across the country. And we want to understand what they are and bring those into other members all across the country. And as importantly, there's a lot of money and time that has been spent on things that have not worked. And we want to make sure that we don't replicate those as well. And we're going to be having some gatherings and symposia about this, and we think we can be a real convener among all of the different stakeholders that care about affordable housing. So this is something we're going to put a lot of emphasis on. Another thing I would mention, Maren, is that there continues to be a real lack of understanding among renters. And mind you, the Mortgage Bankers Association also has a big multifamily contingent, so we love renters too, but renters who could become homeowners and start to build that wealth that Lori mentioned, there's still a conception, it's gotten better. People used to think you needed 20% down to get a house. Recent surveys by Fannie Mae indicate that people think you need 10%. Well, as we all know in this room, you need far less than 10%. You need about 3%. And even at that, there are often down payment assistance programs or seller contributions that actually decrease the number from there. And of course, if you're a veteran, you need no down payment. So there are all sorts of people across this country who are paying rent on time every month at a higher level than they would pay if they bought a house. Now, I'm not saying that the concerns about supply are misplaced, because they are really crucial, and we continue to lose ground as land, labor, and lumber prices have no sign of slowing down, and the problems with zoning and entitlements and other state and local issues. I'm not privy to his remarks. I'm sort of hoping that Secretary Carson will talk a little bit about this at lunch today. I know he has spoken before about how the federal government can have an influence over state and local areas as it relates to how much new housing they build. And I think, as Lori mentioned, I think that's an important part of the solution. There are some who would say that because of the slide that we saw earlier showing that home price appreciation in the more affordable segments has been much faster than in the less affordable segments, that the solution to that is to ration the availability of credit. I think that's completely backwards. I think we need to increase the supply and let more people know that that credit is available to them to become homeowners. And the flip side of the coin about the high appreciation on the entry level is, yes, it makes it harder to get that first house, but once you're in it, your value is appreciating and you can build wealth or you can move up to the next house as your family grows. So viewing that as strictly a negative, I think, misses the mark. And I don't think the solution is to tighten credit availability. And I completely agree with Lori about the absurdity of having a single variable, the DTI, determine whether a loan qualifies for the safe harbor under the qualified mortgage rule. The debt to income ratio is a fraction, and the numerator and the denominator both change real time. So the minute you calculate it, it's already wrong. It's wrong if I make a payment on my credit card and my balance goes down. It's wrong if I pay off my car loan. It's wrong if I get a raise. It's wrong if I'm laid off tomorrow. It's a fleeting measure that, as Lori rightly says, is not very predictive, and it's also wrong the minute you calculate it. So we very much appreciate Ed and Lori's leadership on looking at the QM patch and expanding it beyond that, and the MBA is very supportive of those efforts as well.
Thanks, Bob. Ed, from your viewpoint, how do you think about affordability from a policy perspective? What do you think the federal government should focus on, kind of to Lori's point, and where do you think improvements can be made at the state and local level?
So I think the federal government's approach on this, we've got to move away from the simple approaches that have been taken in the past and have not only gotten the economy into trouble, but has really harmed the very families that were intended to be helped. The solution here is not about weakening underwriting standards or subsidizing the cost of credit so that we mask the price signal. Borrowers don't even realize the kind of risk that they present to themselves, much less to the lender. This is a challenge that requires the kind of partnerships that Bob said, MBA's, taking a lead on. And to do this right, we've got to actually look at what are the hurdles that families face in trying to become homeowners. And I think that applies both on the front end and then the back end as well, once they're in a home. But if we want to help create greater homeownership and make it sustainable, we need to do a lot more work before that family is even approached a realtor or started, walking through houses, much less has a contract on one. Once you've got a contract on a house, is not the time to go, say, okay, I need home buying counseling in order to get this mortgage. This is a process that needs to start earlier. I do think counseling is a really important component and something we ought to be investing in more to help families get ready to become homeowners, to understand their own family balance sheet, to understand their cash flow needs, to understand the risks that they have given their particular circumstances, including their job. One of the things that's changed in the economy in the United States is that family income has gotten a lot more volatile, and we've got to be able to take that volatility into account in the mortgage process. But even before that, families need to understand it as they're considering becoming homeowners and how to prepare to become homeowners. So Bob mentioned down payment assistance, we've got counseling, we've got credit repair activities on the front end that I think are important. And this is a collective effort of industry, counseling services, and federal programs and agencies to help get that done. On the back end, making sure families continue to have sufficient resources to weather those storms. I'll come back to the volatility point. Everybody, faces life events and creates shock. We need to think harder in our mortgage process about where those shock absorbers are for families once they have a mortgage, so that they can withstand some of the disruptions that take place. So those are some thoughts on the affordability side. On the state and local, I want to echo what's been said on this panel and also Sam's comments earlier. I mean, clearly the single biggest challenge in homeownership and affordability is it's a supply issue, and the supply issue is driven in most but not all factors by what's going on at the local level, whether it's land use restrictions, zoning, building requirements, labor issues there. We've really got to focus on the supply issue. I am encouraged that as I attend these kind of events and these discussions, there is more and more discussion going on about supply. And so at least identifying that, wow, we got this huge supply problem, is a first step to starting to say, okay, well then how do we go about solving it?
Got it. And Lori, how do you approach housing affordability? I know you touched on it a bit in your initial remarks, but where in either the federal or state and local side do you see the best solutions coming about and taking shape in the market today?
Okay, so I think the first thing is I think we want to separate out supply and access to credit. And I think to Bob's point, people say, oh well, let's tighten credit to solve the affordability. That doesn't do anything. Basically, everybody needs a place to live. Supply primarily governs home prices. So in some sense, it doesn't matter whether Bob is an owner or a renter. He still needs a place to live. And if an investor buys the property and rents it out to Bob, it hasn't made any difference in aggregate demand. So I think we need to separate out those two issues, and I think we definitely need more supply. We've talked about local zoning, building codes, all that is tremendously important. On the access to credit issues, I think there's a lot of things that can be done to make credit more available. And by the way, on supply, I think ultimately the only way home prices get tamed is if you have that increase in supply. And I think manufactured housing is actually a big part of the solution. When I was a kid growing up in the 70s, we shipped about 240,000 units of manufactured housing a year. Now we ship 100,000. Even though the population has grown. So, I think there are solutions to this, and a lot of them are at the state and local level, as Ed pointed out. There are some solutions. There are a lot of solutions that can increase home ownership. In addition to fixing the False Claims Act and the high cost of FHA servicing, I think there are three things that are critical. The first is better use of alternative credit. Rental pay history is basically not included in credit scores. Yes, it's a variable, but the credit bureaus have information on like 1% of the borrowers, because using bank statements to detect rental pay history could be a real game changer for a lot of borrowers. If you've made your mortgage, if you've paid your rent for the last 2 years with no late payments, the probability that if you're not having a large increase in payments that you can continue you can make payments on a mortgage is really, really high. Better use of using cell phone bills, telecom bills, utility bills as measures of creditworthiness also make a lot of sense. We also need less rigid rules for measuring income, and I think Ed made this point. There are a lot of people who have less stable job histories where the gig economy is a part of where they've got a full-time job and then they do something on the side. We're much more stringent in how we count income than we ever used to be. Now we want 2 years of continual job history, or of the same job, or a job in the same field. So if you go from being a nurse in a nursing home to a nurse in a school, you're not in the same field. I think we need to address that issue. In addition, we need ways to count people who always have a second job, but that second job may change. Some way to count income contributed by those not on the mortgage. And I think the eye in the debt to income ratio is grossly mismeasured. And then finally, using bank statements would be extremely helpful to self-employed borrowers. Self-employed borrowers have been, the homeownership rate among self-employed borrowers has actually fallen fairly dramatically since the implementation, since after the crisis, and I think that's something that needs to be addressed.
That's helpful, and I think you definitely touch on something when you talk about manufactured housing being a solution. We at HUD, and taking myself out of the Ginnie Mae role and talking a bit about HUD, I know Brian and the secretary are very dedicated. I would encourage everyone to go look at the innovation that's taken place in manufactured housing. We held a showcase on the National Mall last week where a series of manufactured houses were on display, and you walk in them and you don't feel like you're in a manufactured housing of the past. So I do think that is an area where especially the FHA and Ginnie can start to look bring solutions to the market in that segment.
Yeah, and just to throw on top of that, I think two takeaways I've had from hearing this so far is, number one, look, Congress struggles to address the things that they have direct domain over, and this isn't one of them. This is much more complicated, not just a DC issue. And so the conversations at the state and municipal and even within the market are vitally important. And number two, I'd throw in there, from the investor community, what I've found most interesting is some of those state level initiatives, both the good and the bad and the questionable. One of the most recurring conversations I've had over the past 3 months is the new rent regulation in New York State. And so as these municipalities continue to try to address some of these affordability questions themselves, I think that it's worth it to remember that this isn't just a federal issue, not just a state issue, not just a local municipality issue, but there needs to be a more holistic approach to the answer.
That's helpful. So I do think we should turn it to Ginnie Mae now that we are at the Ginnie Mae Summit. I think I would ask each of you, from your perspective, if you could give one piece of advice to us at Ginnie, or where you think we should be most focused, what would that be?
Me?
Isaac? Yes.
Oh, great. What can you do better? Nothing, obviously.
That's right. We are opening ourselves up to some criticism, but
that's why I'm here, right?
We can absolutely take it.
No, look, I think, and Ed and I were talking about this before, thinking about the past 10 years in mortgage finance policy conversations, and especially the conversation that happened on the Hill when there was a viable effort in the Senate Banking Committee to undertake mortgage finance reform. In a lot of ways at that time, Ginnie Mae was almost an afterthought, right? You didn't hear Ginnie Mae as being a part of the conversation on the Hill, and that was reflected in the legislative text that we've seen. But over time, with Ted Tozer, Michael Bright, and now Maren Kasper, I think that you've seen a concerted effort to explain to policymakers and market participants what Ginnie does, right? And I can go through it from memory, having heard Maren in particular recently, right? Number one is Ginnie Mae's technological dynamics are not afflicted by the same realities that FHA has. And we've heard that before. FHA's technology is basically marooned in the disco era, right? But Ginnie doesn't have that same problem. Number two is Ginnie's processes and mechanics have been time tested, right? So we know they work. And number three is, as evidenced by this room, Ginnie is an international brand. And look, I didn't know those things 5-10 years ago, but with events like this and sessions on the Hill and explaining how the system works to policymakers, that stuff becomes second nature in their thinking and becomes there invariably part of the broader conversation. So continuing to educate is what I would say.
That's great. Bob?
I think that the single most critical thing that Ginnie Mae can focus on is ensuring a deep, liquid market for Ginnie Mae mortgage servicing rights. And if you think about that as an organizing principle, it ripples through your activities. So we were glad to see that in your update on the Ginnie Mae 2020, you talk about starting the process toward single loan pooling, which would allow the flexibility to do things like when a loan becomes delinquent, and I'm a servicer, and 99.6% of my loans are current, and I'm not very good at servicing delinquent loans, but I know a guy over here who's really good at it. I can move the servicing on that loan without ruining the pool. Right. And there are other things about servicing a Ginnie Mae security that are much more onerous than a similar conventional loan. And we saw astoundingly on Sam's slides that some of the loans that are still in the delinquency process were originated before the last recession. Now that's terrifying given that that's 11 years, but even if you took not the outliers, but you take a loan in a judicial foreclosure state particularly, and in the Ginnie Mae program, the servicer is asked to advance the principal and interest and pay the taxes and insurance until the loan becomes REO and the property is sold. Could be a 2-year obligation versus a much more manageable, shorter period with a conventional loan. And it becomes a self-fulfilling prophecy when you worry about liquidity and capital among issuers, that they have to put out all that extra liquidity and capital to service a delinquent loan. and that there are rules that say if you have a foot fault and miss an interim deadline for something that has no effect on the broader process, you are subject to not being reimbursed for all of those advances, and you make it impossible for, or difficult at least, for lenders to get financing secured by those advances, which you would think would be pretty good collateral because it's got the full faith and credit of the US government behind it. So, and you know the issues, Maren, there's more than that, but the ways in which servicing a loan for Ginnie Mae, and not least of which is the False Claims Act, as has already been talked about, capital sources will return to Ginnie Mae mortgage servicing rights in a deeper and broader way if some of these issues are resolved, and that, to me, is the single thing that will most strengthen Ginnie Mae.
I agree, and thank you. And I think our interests are perfectly aligned there, because from the Ginnie Mae perspective, and why we care so much about that asset being healthy, is in the event of a default or an extinguishment, that's the government's asset. So that's the exact tool that we can use to protect taxpayers, which I would say is our biggest responsibility in an unfortunate circumstance. So we are perfectly aligned on ensuring healthy MSR values. Ed, what would you say for Ginnie?
Well, look, I mean, it's going to be an echo, and so it'll be a quick one. I mean, what you're doing with the Ginnie 2020 plan, the set of changes that you're introducing, really vital. Keep at it, keep going. The evolution of Ginnie Mae over these last 10 years has been nothing short of amazing, as Isaac said. Bob's point about servicing is totally endorsed. It's really well said. I want to, though, also echo Isaac. I mean, if there is something that's going to be a continual effort for Ginnie, it's education. And that includes educating people right in this town. It's amazing how little understood the Ginnie Mae program and process and infrastructure is, and I think the more that you can continue the process of educating folks about just what Ginnie does and how it does it to connect that homeowner in Peoria to these international investors that are supporting the U.S. housing market, and what that role of Ginnie in doing it through, you know, hundreds of different issuers and thousands of lenders it's a story that just continually needs to be told.
Thank you. And I think everyone here in this room can help us on that effort too. So
Right.
I appreciate you bringing that up. Lori, how about yourself?
Okay, so I mean, I think basically, I think you have to make it clear that the False Claims Act is a Ginnie issue as well as an FHA issue. I mean, basically, you know, non-banks comprise 86% of your new origination. It's 90% for FHA, 82% for VA. You know, the banks have basically left this. The banks have basically left this market, and I think that's a very important Ginnie issue. I love the Ginnie 2020 plan. I think you've done a ton of self-examination. You sort of have a real sense of direction. You know, one of the things you mentioned in that is allowing servicers to more readily finance their advances. I think that is a very, very big issue, and I applaud you for already working on it.
Thank you. You know, I think the statement I have said most in the last 2 years is that the composition of our counterparties, thereby our counterparty risk, has changed from banks to non-banks. That's something that we continue to repeat, and we continue to grapple with our current environment, and I hope we're doing so in a responsible manner. But I would ask you guys, do you think that receives enough attention, good or bad? And where do you think we as policymakers have it right? And what else should we be taking into consideration when looking at the bank-non-bank dynamic? Isaac, do you have any thoughts on that?
Yeah, look, in the mortgage finance ecosystem, I think that there are basically like two types of fights that I see. There's the highbrow fight over intellectual things like who owns, who has access to the common securitization platform, right? And then there's sort of the street brawl. And one of the street brawls has been this battle between non-banks and banks and good, bad, otherwise. And I think it's a classic DC problem in that it's far more nuanced than banks versus non-banks. And I think this really hit home for me just a few weeks ago. I was reading the report, the takeaways that you all had from your meetings with counterparties. And it's the reality that no two non-banks are exactly the same. And so work has to be done to understand those nuanced differences between origination models and hedging strategies, et cetera. And as long as that work is done in order to understand the operational and counterparty dynamics, then we can have the real policy conversation, which is looking through the prism of creating and fostering a dynamic that invites a diverse issuer base, which I think should ultimately be the goal. So it's just a question of how to get there. Fix the False Claims Act to help bring banks back in. Understand the differences between non-bank strategies in order to diversify the issuer base as best as possible. I think that's occurring now. I think it's a lot of work. It probably took a fair amount of your time.
It does, yep.
So yes, I think as long as it's done through that prism of how can we diversify that issuer base, then all of these conversations are worthwhile.
Absolutely. Hey, Bob, do you have thoughts?
Isaac, that was beautifully stated. I think he summed it up really well. And I think, Maren, you mentioned that this business about no two non-banks are alike, and that diversification is a strength.
That's right.
And having a diverse group of counterparties. And you're rightly focusing on not what is the structure of the entity, but how well do they manage risk? How well do they plan for drops in margins, increases in delinquencies, more demands on their liquidity? What is the composition of their capital? That's exactly where you should be focusing, not on whether they are an insured depository or they're another sort of institution. So we think that there's been great progress there. There are fewer, I think, knock on wood, because there'll be one when I leave here today, but there are fewer stories in the press that completely gloss over the facts and conflate things and say, here comes the next crisis. I'm sure there'll be more, but we're working hard to get the facts out, and appreciate you're doing the same, so that there's not some knee-jerk reaction that says, if the counterparties are non-banks instead of banks, therefore crisis awaits.
Right.
So we appreciate the partnership on that.
I think that's right, and I think as we think about our counterparty risk framework, you all are touching on an important part, that no two non-banks are the same. That means our framework can't be just a brushstroke risk policy or guide policy that applies to everybody. So there will be more coming from Ginnie Mae as to how we tailor our risk approach to account for the differentiation in business models that are in the non-bank system. Ed, do you have thoughts on that?
I mean, I think everything's been
Okay.
pretty well said. I mean, it's
Okay.
getting that level playing field is really important.
Lori, I
I have
invite this-
two very quick
Okay.
thoughts.
Perfect.
The first is, I think we all understand the vulnerabilities with some of the weaker capitalized non-banks, but I think we have to acknowledge the very important role they've played in terms of access to credit. The non-bank credit box is wider. They have lower average credit scores. They have higher average debt to income. So, I mean, I think, they have played a very, very valuable role in terms of access to credit. And then I think, the elephant in the room is who should have access to home loan bank membership. And that's something we haven't talked about, because when you talk about, we're sort of all racing around trying to figure out, well, gee, how do we solve these funding problems? There's one obvious solution, and I'm not sure it's something that it should at least be addressed and talked about, and it's not getting very much play. But as the mortgage market has evolved, the purpose of the home loan bank system was supposed to be to support that market. And I think it's something that should at least be looked at. It does require congressional approval, but right now only banks, depository institutions, insurance companies, and CDFIs are eligible for home loan bank membership, and again, something to be considered.
And there's the whole REIT issue tied up there as well.
REITs and non-banks both play very major roles in the system. Neither one is eligible. There were some attempts a number of years ago to get in through being captive insurance companies. The FHFA shut that down, arguing that this should be a congressional action, and it should, and I think it needs to be addressed.
Got it. So we only have a few minutes left, and I swear I'm not kicking off another hour-long panel, but I will turn to housing finance reform. I know each of you mentioned the memo that's coming, and the anticipation is that our administration will put that out sometime this summer. and start the collaboration process across ourselves at HUD and Treasury and the FHFA. If I could ask each of you, what would be one or two things that you are most looking forward to seeing from the plan and truly hope is in there based on all 17 directives that were put out in the memo? Isaac, do you have any thoughts on that?
Sure. Look, I'm going to do three really quick, I promise. Number one is conservatorship for the GSEs, right? And I think there are two main hurdles that I'm trying to gauge there is how is the administration thinking from a political will standpoint with their commitment to ending it? And then how do they address some of the massive technical questions relating to the end of the conservatorship? Does the backstop convey things along those lines? Number two is how aggressively will the administration think about shrinking the federal footprint? In my world, we talk a lot about curtailing cash-out refis, investor properties, second homes, multifamily on the GSE side, but I think I'm going to be intrigued to see how much the administration is thinking about doing that independently within the GSEs, but also within the context of the interconnectivity of the federal footprint, which I think is vitally important. And then number three, I am incredibly interested, and I think that Lori hit on it. What are they going to do about FHLB membership? I think we've had lots of opinions over the past few years, but it'll be interesting to see one firm position from the administration.
Great. Bob?
The potential perverse result of administrative reform is that you take loans that are currently being made by Fannie Mae and Freddie Mac with borrowers' down payment, private mortgage insurance if the LTV is over 80, and credit risk transfer on the back end to disperse the risk out of taxpayers' way. If you take loans that are being done there and say, no, they're now going to FHA with the 100% full faith and credit of the US government and a very small down payment but no private capital beyond that, that does not serve to de-risk the taxpayer. And we think that it's a really important balance. And again, this is why we're glad that HUD is doing a report as well as Treasury, because if the effect of what the FHFA could do in terms of curtailment moves loans to FHA. Now, if it moves it to the private sector, if it puts it on banks' balance sheets, or if it puts it in a revitalized private label mortgage securities market, we're all for that. But if the result is that it goes to FHA and the adverse selection that already happens between conventional markets and FHA accelerates, that's a very troubling result. So that's something we're keeping an eye on. And the second piece I would mention is that the importance of getting the timing right so that you ensure that the cross-subsidization that occurs within, and not so much timing actually, the cross-subsidization that occurs even within the GSE's own books. If you say, I don't think the charter of the GSEs is to make second homes on the beach for affluent people. Well, if the current loan level price adjustments mean that those loans are very profitable, then having Fannie and Freddie make those loans enables them to make the affordable loan products to first-time home buyers of low-wealth households in an affordable way because of the cross-subsidization. And that's a broad policy issue that I think needs to be considered as Director Calabria starts playing with the dials.
That's right. Ed?
I'll be looking for a big picture takeaway from each report. The first is on the Treasury report. Is this lip service about legislative reform, or do I read this report and come away thinking they've absorbed the growing consensus legislatively and they're embracing it and putting forward some specifics about how to bring Congress together and demonstrate that the executive branch is really finally ready to fully engage with members of Congress to get legislation done. That's what I'm looking for in the Treasury report. And the HUD report, as I said, is it little bits issues here and there, or is it thinking about how do we make FHA work for the 21st century? Is it a modernized FHA approach?
Absolutely. And Lori?
In the Treasury report, I think I too am looking for the big picture takeaway. And what worries me a little bit is if they don't get it right, it's going to look like a giant game of chicken, where if Congress doesn't act, then we restore the old system. And so I'm hoping that it won't look like that. And I'm sure that there's been a lot of fine minds on it, and it won't. But that is what I see as the danger, going down the path we seem to be going. And then the second thing is, sort of cross-subsidization is an important part of the GSE's of the GSE model, where the stronger loans sort of subsidize the weaker loans, and it's all implicit. And as you move toward GSE reform, where you put private capital first, obviously that means risk-based pricing, and the question is, how do you actually handle that in a new structure? Either you have to shoehorn in the cross-subsidization, or you have to do it with some sort of an explicit market fee that's then redistributed. And I think that's a whole interesting set of questions in terms of how you handle the cross-subsidization, but in any case, it has to be explicit.
Good. Well, we are out of time, but I greatly appreciate all of your thoughts. I think this has really been fantastic dialogue. For everyone in attendance, we are now moving to our breakout sessions that start at 11 a.m., so I encourage you to attend them, and we will be back here at noon for lunch and Secretary Carson. Thank you guys again.
Thank you.